Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story, investors mapping out growing odds of a second Trump term. Joe Quinlan of Merrill and Bank of America Private Bank writing this: the key variable to watch is the US dollar. Will foreigners vote with their wallet per the US election, owning 28% of marketable treasuries, 32% of the corporate bond market and 20% of US equities? Joe joins us now for more. Joe, let's talk about this. Your reaction to what happened on Thursday night and what you think it means for this market.
Well, John, post Thursday night, I was watching the dollar very carefully over in Asia and Europe, and really no sell-off here related to any political unrest here in the United States or uncertainty. You know, you were just talking, you and Lisa, about the dollar. It's what the dollar has strength. I'm surprised it's not stronger because what's behind the dollar is the great U.S. economy, the private sector, the most productive economy out there. And when I talk to sovereign wealth funds or family offices around the world, they want to own U.S. assets, and there's a preference and a premium on owning U.S. securities. I don't think that's going to change between now and the election. Some uncertainty, but no big change.
Joe, let's talk about what would happen on a Trump win. Got to go through a couple of steps here, but for the sake of scenario analysis, let's say he gets a win. Let's even go one step further. Let's say we get that red wave. I'm thinking back to 2016. A lot of people are thinking about the Trump playbook of that time, and this bond market was demanding bond issuance. In fact, the economic backdrop demanded fiscal stimulus. That's not where we're at in 2024. And if you think about the trades that worked back then, yes, yields climbed, yes, the dollar rallied, but small caps that month in November 2016 rallied by 11%. Joe, I'm just wondering if that's the trade this time around, because that's not what I see in small caps in the last 24 hours.
I mean, the small caps are still in purgatory here. John, you could be right in the sense that if you got an administration that's bent on doing things here in the United States, tariffs, anti-immigration, we're going to have to raise the bar. We're going to have to increase our production across the board, not just large cap, small cap. So it could spread, but to me, it'd be for all the wrong reasons. Nationalism, protectionism. So I think that trade it could come back, but to me, it doesn't give me any comfort because I think small caps can come back on their own, but if it's through policy protectionism, that's a different animal altogether. But I understand exactly where you're going, and small caps will have their day, I think, under a Republican sweep.
Joe, I'm wondering how far out you can actually make some sort of prediction. We were talking earlier, John raised Lori Calvasina and talking about how there just is no visibility around 2025. Do you feel the same way?
No, actually I don't, Lisa. I think 2025, yes, the policy backdrop becomes a little more uncertain. But when you step back, look at the AI revolution, the productivity that's coming, look at the U.S. economy in general relative to the rest of the world, look at the geopolitics, there's places put money to work, there's a premium on resources, the infrastructure build is going to continue. So there's policy fog, but I think there's opportunities to put money to work in certain sectors that irregardless, doesn't matter what's happening with politics, it's going to continue into the second half of this decade.
A lot of people were worried about valuations, particularly in some of the areas that you mentioned, AI in particular, looking at NVIDIA's some kind of 140% gain so far this year. You're seeing it kind of trade range bound over the past few trading sessions. Do you agree that it is concerning where valuations are, that there should be some sort of retracement before you feel comfortable really doubling down on those names?
I mean, to a degree, Lisa, yes, we're getting a little, there's a lot of bullish sentiment in the market, so we're careful about that, putting new money to work. But these companies are backing up these valuation with earnings growth, and we see that continuing. Is that going to continue into 2025? Probably not. Year-over-year comps are going to come down, but we're still comfortable owning this market, broadening out. We like the cyclicals. We still like energy. I like commodities. Anything related to transportation and distribution, transmission, we like that space as well. So we're very bullish on defense spending, given where we are. So, yes, there's parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption, and foreign demand coming back to you for U.S. securities.
Joe, build on that. Energy, defense. Is there some connection there between the two?
Absolutely, John, because what's the premium? United States is energy independent, relatively speaking, but certainly relative to Europe and Asia. So you got all this demand for AI, these data centers. There's only one country really that can feed this beast, right? This AI beast in a relative way, and that's the United States, because we're energy independent. People haven't made the connection. If you want to drive data, drive AI, you need energy. Who has the energy? The United States. We're going to pull ahead because of our energy independence driving AI, artificial intelligence. We're going to pull ahead of the rest of the world. And that's what the bet people are making when they buy the U.S. relative to the rest of the world.
Joe, let's go one step. What am I buying then? Utilities, energy providers? Is it the oil producers, energy services? Where am I going for that trade?
Our equity analysts like the whole spectrum, John, but also transmission, distribution, the utilities, really across the spectrum. We like renewables as well in this space. The interconnection queue, people don't talk about that. We've got to get that better. We've got to be able to take all this renewable capacity and plug it in. It's that simple, and we're missing it. So I think that's coming down the pipeline, more infrastructure on just basic transmission wires, distribution, getting this out. And I think that's a whole new ball game for U.S. competitiveness.
I want to be at the Independence Day celebration at your house, Joe. It seems like it's going to be exciting. I do think that there is a question when you talk about energy, particularly on a day like today where you do see oil prices climbing to the highest levels going back to April. And this is on the heels of both the Hurricane Beryl that's going, the first one on records going back to the 1800s that really has reached that Category 5 level. How concerned are you about a potential spike in prices over the summer if there is some sort of hurricane season that is as violent as some people are worried about?
Well, listen, I would say to be short term, the spike up in prices, because there's plenty of oil out there globally, not just here in the United States as well. So, yes, that's a concern. But to me, longer term is everything we just talked about. It's the demand for electricity, EVs, data centers. So we're watching the hurricane season. In particular when it comes to insurance companies. What does it mean to get insurance and for housing and these other businesses that we've been talking about? That's a big issue. Fires, the climate change, the climate mitigation is broadening out for insurance companies. It's broadening out. It's going to affect more consumers. I think that's going to be a bigger issue in the second half of this decade that we're going to be talking about.
Brent, back in the high 80s, 87. Joe, it's good to hear from you. Joe Quinlan there of Merrill and Bank of America Private Bank. Key theme for Joe, preference for hard power, defense, hard assets, commodities, hard hats, infrastructure. President Biden slamming a Supreme Court ruling that could allow Donald Trump to escape prosecution for his role in the January 6th riot on Capitol Hill. Biden's comments coming as his campaign looks to move the narrative away from last week's debate debacle, which saw a growing number of Americans question the president's ability to serve. Joining us now is Jeannette Lowe of Strategas, a Baird company. Jeannette, I've got to say, you're on the money when it comes to what you're focused on, and that's the tight Senate races that we should all be watching. And if those start to shift, maybe this president's in even more trouble than he already is. Jeannette, what are you seeing in those tight races now?
Yeah, good morning. So, it's a great point. The big thing that we're seeing coming out of Thursday is that everyone's worried about Biden being at the top of the ticket and now potentially having that debate performance that really did not change the election trajectory the way he wanted it to do. The bigger impact is what's going to happen in these down ballot races. And so one thing that's really important is that you are seeing Democratic senators who are, in general, it is more difficult to actually unseat an incumbent senator. We have Democratic senators in states like Pennsylvania and Wisconsin and Arizona who are actually currently outrunning Biden in the polls. And so I think that if you start to see those numbers really change direction over the course of the next few weeks, right now the Democratic Party is kind of rallying around Biden, saying that they're going to have him remain at the top of the ticket. But if you really start to see deterioration in the polls, deterioration in fundraising, and deterioration in the polling for these down ballot states, that's going to pose a lot more trouble for the Democratic Party come November.
You mentioned three things there: polling, fundraising, down ballot Senate races. Can we talk about fundraising? Some of the numbers that I've been seeing, Jeannette, say there's no problem here whatsoever. What are the numbers that you're looking at?
Right. So right now there is no problem. So they had pretty good numbers over the weekend for the Democratic side. We'll have to see. I think right now, they're definitely concerned that the Republicans are having really good fundraising and kind of eating into the fundraising advantage that Biden did have earlier this year. But right now there is kind of this rallying right around him. You had the president come out and speak last night about the Supreme Court decision. This is really him trying to reframe, maybe try to get some of those images of Thursday night out of the public view and put some new images out there. So him taking that stand last night to make a statement was important for the campaign to try to reset and to try to change the narrative a little bit away from that debate performance and be a little bit more presidential. So I think that we're going to be watching those numbers. Right now, everything does seem to be okay, but I think the next couple of weeks are going to be really critical for this race.
There's some discussion of the DNC, Bloomberg reporting that the Democratic National Convention Committee is thinking of actually pulling forward the nomination of Joe Biden to try to throw a sense of support behind him. Is this the right idea, given the fact that anger is still out there, very much so, and there's a question of why the internal circle around Biden isn't necessarily being more transparent about this process?
Right. And this is something that was actually kind of planned a little bit earlier. They were thinking about doing it before August 7th, just because there had been issues with the Ohio ballot. And so the party wanted to have him basically nominated early, just so that there couldn't be any turmoil at the convention in August. If you have a contentious convention, that generally doesn't bode very well for the party ahead of the actual election. And so that was something that they were actually trying to avoid. But one of the things that they're trying to do now is thinking about, okay, well, if we can actually move this forward, that would kind of solidify Biden as the nominee. You can't have people coming up at the convention trying to throw another candidate's name into the hat. But this is ultimately going to be, for better or for worse, this is down to Biden making the decision whether he wants to stay at the top of the ticket or if he wants to step down. He can do that before the convention. That could be very messy, having multiple delegates having votes to figure out who should be the next nominee. The committee can also do it after the convention as well, or we could see Biden stay in the entire time. But I think this move to potentially have the nomination done in July is a way to try to squash any dissent. If Biden can keep his numbers up over the next couple of weeks, we don't see a great deterioration in polling. If we can see him making more statements like last night than last Thursday, I think that would be something that would allow him to stay at the ticket. But this is something definitely to be watching.
Jeanette, yesterday we had a series of guests talking about how Thursday night was a game changer for them in the market, that essentially they were looking at the much higher likelihood of a Republican sweep, exactly going to your first point, which is essentially you need to watch down ballot and see how many people basically stay home, are not excited about the top of the ticket, don't feel like they're being heard by the Democratic Party. How much is that something that you're seeing as a much greater likelihood today than, say, Thursday morning?
So I'll agree. I think the consensus is that there is definitely a greater chance that we're going to have a Republican sweep in this election. But I do think it is important to not assume that that would be the case. Again, these down ballot races are quite important. What we have kind of seen is that it seems that there's a much bigger problem with Biden and Harris at the top of the ticket rather than an overall problem with the Democratic brand. So you do see House races that have done quite well. You do also see these Senate races, again, where the Democratic candidates are outperforming Biden in key swing states. The other thing I think that what's important to watch is we don't want to just watch just what the polls say. We want to see actual results. So we've been watching the special elections that have occurred since January, and Democrats have been outperforming by 11 percentage points versus what happened in those districts in the last election. So that does seem to indicate that there could be some ticket splitting this year. It could be that voters might think that they could vote for maybe Trump at the top of the ticket, but then Democrats either in the House or the Senate races. The important thing to remember is that currently Congress has very tight majorities in both the House and the Senate. It will not take a lot of seats one way or the other to really move that, but there is still the possibility that maybe we don't see a Republican sweep. Maybe we actually see a divided Congress next year.
Jeanette, you get the distinct sense right now that a lot of people in this country feel like they're being lied to, like there's a division emerging between the campaign and the rest of this country. And I don't know what this campaign does about that. If I think about some of the stories over the weekend, we saw even CNN getting blamed for the makeup they used on Joe Biden as if that was the problem on Thursday night. What do you think they're going to do over the next 4 months to try and right course what we've been seeing, not just on Thursday night, but for the last 12 months?
Right. And so, I mean, I think that Thursday's debate definitely reinforced voters' concerns about Biden's age, about his fitness to continue to serve as the president. And the president really needs to try to change this race. It is currently a referendum on his first term in office. His approval rating is hovering around 40%. That is not good if you're looking to get reelected. So he really does need to change this into a choice. There are some key factors to look for in the coming days. Obviously, with the Supreme Court decision yesterday, you saw Biden's statement to try to change this, to try to say, okay, that was the decision, but I'm going to try to frame this as more of a choice between me and former President Trump. You also have Trump's sentencing coming up next week, so that's going to be an important point. Things also to watch for is who is the vice presidential pick on the Republican ticket. So there are options for the Democratic Party to try to reframe the race, to make it just more of a choice between Trump and Biden. But there already is kind of this baked-in feeling that voters have been concerned about Biden's age.
Yep.
That wasn't alleviated over the course of the last week, and that's something that they're going to have to figure out how to deal with.
Jeannette, this was great. Jeannette Lowe of Strategas, thank you. Continue this conversation and get to the panel. Joining us now is Point 72's Dean Maki, alongside BMO's Ian Lyngen. Gents, it's great to catch up with you both. Ian, I'm going to come to you first. What is more important to this bond market right now? The economic data that we get this week, or the debate that took place Thursday evening?
Well, over the course of the last two trading sessions, it has undoubtedly been the political tides in Washington and what it means for November. That being said, we have payrolls on Friday, but perhaps more importantly, next week we get CPI again, and that will give the market some very good context for whether or not we'll see that September rate cut. That's the active debate that matters at the moment.
Ian, there's still some banks out there suggesting that maybe payrolls this Friday is more important than CPI next week. Would you take the other side of that?
I would take the other side of it in a consensus print. But if there's a surprise, if you get a 4.2 unemployment rate or a sub 100,000 print for headline payrolls, then all of a sudden the dual mandate employment aspect becomes a lot more relevant than CPI.
Dean, how are you thinking about that trade-off? If unemployment continues to creep higher this Friday, does it take some weight away from the importance of CPI next Thursday?
I think at this point, the Fed really is focused on inflation. The Fed needs to see inflation headed back toward the 2% target. And if that's the case, then we can have a strong payroll report and the Fed will still think about cutting. So I think the Fed's focus really is on the CPI next week.
Dean, how do you understand what some of the data has been saying in terms of slowing but not slow? There is this feeling right now, especially as you look more to the inflation print than you do the labor market, there has been this feeling that we're on the precipice of something that could be more punitive for the U.S. economy. Do you agree? And if not, why not?
I don't agree. I think there's been some mixed shifts within the data that make some of the data look weaker than it really is. So, for example, consumers are shifting away from spending on goods and food services and towards other categories. But those other categories are not included in retail sales. So retail sales looks weaker than overall consumer spending, but markets tend to focus only on the retail sales report. So that's part of what's happening, is that consumers are shifting toward pre-COVID norms, and that's not showing up in some of the data that people are focused on.
Do you agree, Ian?
So I would say that, generally speaking, on the consumption side, I agree. But I am a bit more concerned as it pertains to what's going on in the employment landscape. We do have higher claims. We have the JOLTS quit rate at 2.2%. And there are signs that the Fed has been effective in reintroducing balance to the labor market. But my concern is whether or not the pendulum swings too far in the side of, or toward the side of cooling, and then that starts to perpetuate on itself, and it's difficult for the Fed to address that without some type of policy response.
This is the worry that Claudia Sam has as well. We had her on the programme with us a little bit earlier this morning. We quoted her before we went into some of her work. I just want to share this quote with you, gentlemen. A good labour market is not a reason to wait. The reason to cut is that inflation is down considerably. A good labour market is what it's at risk if the Fed doesn't move. Dean, how do you think about that framing going into the July meeting at the end of this month and ultimately when Chairman Powell speaks in about 45 minutes?
I guess I'm a little less worried about the labor market at this point than some people are. And one reason is that corporate profit margins are close to the highest level since the 1960s. And corporations are not inclined to do massive layoffs with profitability that strong. You know, payroll growth over the last 3 months is 250,000 per month. Jobless claims are in the 230s. This still looks like a pretty good labor market to me. What I think has happened is the labor market has normalized rather than weakened sharply.
Ian, this has big implications, consequences for the shape of the yield curve. We came into 2024, we were looking for steepness, but we thought it would be driven by a rate cutting cycle, fueling a rally at the front end of the curve. Can you just put some meat on the bones of this bear steepener of the last couple of days, Ian? How sustainable you think this move actually is? A disinverting yield curve driven by the long end?
So I think that we all know the story. It has to do with the potential of Trump regaining the White House and some of the forward inflationary implications of that. That steepened out the curve. Deficit spending implies greater issuance. So that's why we had a bear steepener. Now transitioning this to a bull steepener, I think will require at least an initial bear flattening impulse as the economic data starts to deteriorate. But eventually, what we'll see is when it becomes abundantly clear that the Fed is about to start normalizing yields or policy rates lower, 2-year yields will drop and they'll price in an extended cycle back to some version of neutral. And so we could easily see a 50, 60 basis point rally in the 2-year sector once the process starts, and that should re-steepen the yield curve and put the benchmark 2s, 10s curve back into positive territory.
So, Ian, do you kind of agree with John Stoltzfus that this is essentially the bond market looking for attention from the Fed?
To a large extent, the bond market is tightening for the Fed at a moment where the Fed is considering dialing it back. So I do think that to some extent, this is a reminder that flows and supply and demand do matter in the Treasury market, but only within the context of the prevailing range. Keep in mind, 10-year yields are still below 450. And this in an environment where the real economy still appears to be on strong footing, at least for the time being.
Dean, you've been in the market for decades trying to analyze the economics of the moment. I would love your insight into how realistic we can be about some of the potential scenarios that are being priced into the bond market, with really Thursday night being thought of as a watershed moment, really looking for the potential for a Republican sweep and the idea of some of the fiscal policies, as well as tariffs, et cetera, put into place. Is that something that you are gaming out actively and think is a bettable type of option?
I think we always want to be thinking about all of the various scenarios, and markets will try to price in what might happen. But ultimately, from my experience, markets don't really fully price things in until the market is pretty sure it's going to happen. So we might see the scenario shift back and forth multiple times in the next several months before it finally settles on what truly is going to happen.
Hey, gents, this was great. Dean Maki of Point 72, Ian Lyngen of BMO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.